Chair, you say what Fed officials say over the next 48 hours could be critical to emerging markets, specifically China. Tell us what you're seeing.
Yeah, hi, Seema. So I think that if you look at emerging markets, there are about 150 developing countries out there. So I think that the Fed's decision has a different impact on different markets. But clearly the most vulnerable to me is China, because, we've spoken so much about inflation and how inflation is rising everywhere. But one country that is still suffering from possible deflation is China. That China's property market is nearly bust. They are being forced to roll out massive amounts of stimulus, not as much as they used to do, but still considerable amount of stimulus, and they're cutting rates. But their ability to stimulate and cut interest rates is going to be constrained by the fact that the Fed is increasing interest rates, because that accelerates capital outflows from China. They don't want a repeat of that. The currency has already depreciated around 7% or so this year. They don't want a very sharp depreciation of the currency. So I think China is the one emerging market possibly most vulnerable to more Fed tightening.
So negative on China, but I believe you're still bullish on other emerging markets that could perhaps get around a stronger dollar and higher rates. Which ones are those?
Well, I think we've already seen a lot of resilience. If you look at the markets around the world today, once again, some of the most resilient markets have also been in emerging markets, such as Brazil, Indonesia. India's had a remarkable run over the last couple of months. So I think that these were all countries, if you recall, a decade ago, were being clubbed as the fragile five because of their large current account deficits and bad fiscal positions. So those have all improved significantly from back then. So these are some of the countries that I think could keep doing well and have already shown a remarkable amount of resilience at a time when the U.S. market's down 10-15%, and usually a strong dollar would not be good for these countries. But these emerging markets, I think, have stood up relatively well.
Let me ask you a wacky question. Would China rather be America economically? In other words, with the problems they are facing, including a big issue of are we going to be able to manufacture enough jobs for the young people who want jobs? That's exactly the opposite of what the problem is here in the United States. We've got more jobs than we have people seeking them. How do you react to that sort of wacky thought that China may be in a less desirable economic position right now than America is?
Well, that's a great point, and I completely agree with you, which is the fact that, in fact, a projection I'm currently working on is the fact that I don't think the Chinese economy is going to catch up with the U.S. economy in the foreseeable future. A lot of people thought that in current dollar terms by now, the Chinese economy would have overtaken the U.S. economy. I think the gap is considerable. And guess what? I don't think that China is going to catch up with the U.S. economy for the next 10, 20, or even 30 years because their demographic situation is a lot worse. Their debt situation is arguably worse. And I think their long-term growth prospects are not looking good at all. So I don't see the Chinese economy doing well. And you talk about unemployment. If you look at the key cohort of people in their 20s, the Chinese unemployment rate is way higher than the U.S. unemployment rate. So at this stage, yeah, I'd rather be the American economy than the Chinese economy any day.